Hello everyone and welcome to the channel. Global financial stability just got an orange code from the Dutch central bank. Not yellow, not red, orange. In other words, nothing's on fire yet, but keep your shoes on and don't unpack your bags. The Nederlandsche Bank has basically said the quiet part out loud. It's no longer a question if we get the next shock, it's when and where it hits. Their autumn financial stability report spells it out. Geopolitical tension, trade fragmentation, U.S. equity valuations on steroids, rising sovereign risks in Europe, and a growing pile of leverage hiding in shadows. So let's take this apart calmly, without hysterics and without fairy tales. DNB is looking at three layers at once. Macro layer, trade fragmentation, tariff wars, sanctions, weaponized supply chains. Market layer, U.S. stock indices at historically high valuations, driven by AI hype, cheap money hangover, and pure human greed. Plumbing layer, more digital risks, more cyber attacks, more complexity in payment and settlement systems. The message is simple. The probability of a serious shock is high, and the system is fragile in multiple places at the same time. Not black swan, just normal, 2025. They are especially worried about U.S. sovereign debt dynamics and political pressure on institutions like the Fed. If the anchor of the global system starts wobbling, Dutch banks, insurers, and pension funds feel it instantly through U.S. treasuries, and global risk repricing U.S. stock indices have been pushed up approximately 20% since spring on AI optimism, strong macro data, and megacap tech earnings. Then we saw a sharp monthly correction, classic late cycle behavior. Vertical up, then sudden mood swing. DNB's president, Olaf Slijpen, is polite. He refuses to call it an AI bubble, but notes that valuations are historically high and concentration risk is obvious translation from central bankiers. If you dump your entire pension into USA, stocks at the top, don't cry later. Dutch pension funds, fortunately, are not that suicidal. They're diversified across asset classes and geographies, but if the U.S. tech AI complex blows up, global risk appetite falls, spreads widen, and the risk-free rate is no longer risk-free in political terms, then the Dutch system takes a hit through mark-to-market, dollar funding costs, and confidence channels. That's what Orange Code is about. Next risk block, stablecoins. Global stablecoin supply has already passed $300 billion, mostly dollar-pegged tokens backed by U.S. treasuries, deposits, and money market instruments. DNB's angle is pragmatic. On one side, technology is useful. Faster cross-border payments, 24/7 settlement, programmable money. On the other side, if everyone runs for the exit at once and stablecoin issuers must dump treasuries into a stressed market, you get forced selling, liquidity spirals, and fun with collateral values. So the Dutch line is, regulate them like real financial institutions. Don't pretend it's some innocent Web3 experiment. And don't let a 300+ billion side system destabilize the boring core of the financial sector. Now the good news, such kako jest. Banks, well capitalized, liquid, past previous stress waves, intact. Insurers and pension funds, technically strong, with long-term liabilities well matched. Macro position, competitive corporate sector, strong institutions, high education level, deep integration into EU markets. That's the nice brochure the problems sit underneath. Productivity growth is weak, wages and costs are rising, export prices go up, margin pressure follows. Policy noise is high, debates over taxation, housing, migration, climate rules, and now additional exit-style taxes on people and pensioners trying to move their capital and lives elsewhere. Energy, the country that loves spot gas and flexible markets, is now living with structurally higher price risk. Remember the line, who refused long-term gas contracts and switched to spot auctions? Well, did your spots help? Or was that just an expensive lesson in applied ideology? DNB says it directly. The Netherlands wins with a functioning EU and loses if the European project fails. This is linear, not optional. 3 structural pillars. 1, deeper single market and harmonized rules. Same rules, less regulatory fragmentation, easier cross-border scaling. Without this, Dutch firms either stagnate in a small home market or move out. 2. Capital Markets Union. Integrated EU capital markets would give mid-sized Dutch and European companies cheaper, deeper access to equity and risk capital. That matters when bank balance sheets are constrained and private credit is growing in the shadows. 3. Smarter, not weaker, banking regulation. Simplifying rules is fine as long as it doesn't encourage the familiar game, privatize the gains, socialize the losses. The irony, at the same time as they talk about competitiveness and integration, some governments push higher taxes on mobile capital and people, from extended tax claims on pensioners abroad to potential exit taxes on immigrants. Strategically, that's how you create exactly the kind of slow bleed erosion that never makes headlines until the productive class has quietly left. For me, the message from Amsterdam is very simple. Global uncertainty is structurally high. Asset prices, especially in US tech AI, are stretched. Stablecoins and shadow credit are growing faster than regulation and risk understanding. Europe is politically fragmented and fiscally stressed. The Dutch system is strong for now, but it sits inside this ecosystem, not above it. Orange code means this is not the time for single bet strategies, leverage fantasies, or blind faith in eternal AI bull markets. It's also not the time to pretend Europe can drown itself in bureaucracy, energy mispricing, and random tax experiments without consequences. You don't control the shocks, you control your exposure, your structure, and your ability to stay solvent when other people discover gravity. That's the whole story. Thank you for watching. Take care of yourselves and your loved ones, and try to remember, slogans don't power grids, systems do.